Let us look at an example of break-even point analysis and contribution margin. So Vaibhav Goyal plans to sell the know-it-all software at a heavily attended 5-day software convention in Boston. Now Vaibhav can purchase this software from a computer software company at $120 per package, with an understanding that all the unsold software will be returned for a full refund. So basically what this means is that Vaibhav has done an agreement with the computer software company that if he takes 10 packages of the software to the convention, and if he's able to sell only 5 out of those 10, then the remaining 5 he can return back to the company without paying any cost for that, and he'll incur only the cost of the 5 packages which he was able to sell. So the cost to Vaibhav is $120 per package that he sells. Now the software will be sold at $200 each. So this is the unit selling price and this is the unit cost. Now he has already paid $2,000 to the organizers of the convention. And assuming that there are no other costs, what profits will Vaibhav make for different quantities of units sold? So he has already paid a cost of $2,000 to the organizers of the convention. So this is the fixed cost that he has already paid. Now this is known as the fixed cost because irrespective of the number of units that Vaibhav sells, this cost is going to remain constant. So since we have to find out the profit that Vaibhav will make for different quantities of units sold, I have created a sample table with different quantities that Vaibhav might sell. So the analysis that we'll be doing will be on quantities 0, 1, 5, 25 and 40. So first let's find out the revenue that will be generated for these different quantities at $200 per package. So for 0 quantities the revenue will be 0. For 1 the revenue will be 200 multiplied by 1, which is 200. For 5 it will be 200 multiplied by 5, which is 1000. For 25 it will be 200 multiplied by 25, which is 5000. And for 40 it will be 200 multiplied by 40, which will be $8,000. Now the next we'll do is the cost. So variable cost at $120 per package. So for 0 quantity the cost is going to be 0. For 1 the cost will be 120 multiplied by 1, which is 120. For 5 the cost will be 120 multiplied by 5, which is 600. For 25 the cost will be 120 multiplied by 25. So 12 multiplied by 25 is 300 and then one more 0. So this is 3000. And for 40, 12 multiplied by 4 is 48. So 4800. So for all these different quantities we have the revenue as well as the variable cost. And now let's find out the contribution margin. That means how much of this revenue is being contributed to pay for the fixed cost of $2,000. Now we know that the contribution margin is the difference between the unit selling price and the unit variable cost. So contribution margin is 200 minus 120, which is $80 per unit. So contribution margin at $80 per unit. So for 0 quantities sold, the contribution margin is 0. For 1, it is 80 multiplied by 1, which is 80. For 5, 80 multiplied by 5, which is 400. I mean, we can either multiply this 5 with 80, or we can simply subtract the variable cost for 5 units from the revenue for 5 units. So 1000 minus 600 is 400. Similarly for 25, 5000 minus 3000, which is 2000. For 40, 8000 minus 4800, which is 3200. Now this contribution margin will be initially contributing towards paying for the fixed cost, and then once the fixed cost is recovered, then it will start contributing to the profit. So let's find out at what quantity will it start generating profits. So next, what we'll mention here is the fixed costs. This is $2,000, $2,000, $2,000, $2,000, and $2,000. So this is constant irrespective of the number of packages sold. And finally, what we'll find out is the operating income. So operating income will be equal to the contribution margin minus the fixed cost, because contribution margin is the amount that we are getting after subtracting variable costs from the revenue, and that contribution margin is contributing towards the fixed cost. So 0 minus 2000, so this is a loss of $2,000. 80 minus 2000, this is a loss of $1,920. 400 minus 2000, this is a loss of 1600. 2000 minus 2000, this is 0, that is no profit, no loss. And 3200 minus 2000, this is a profit of $1,200. So what this means is that till 25 units are sold, WebHub is not going to make any profit. And after 25 units, each unit will then contribute to profits, and at 40 units, the profit will be $1,200. Now let's also calculate some other measures. Now we know that contribution margin percentage is equal to the unit contribution margin divided by the unit selling price multiplied by 100. So this is equal to, contribution margin is $80, so 80 divided by unit selling price is 200 multiplied by 100. So these two zeros get cancelled. 2 multiplied by 40 is 80, so this is 40%. So the contribution margin percentage is 40%. What this means is that out of the selling price, 40% is being contributed towards the fixed cost. Now let's also calculate the break-even point in terms of units. So this is fixed cost divided by the unit contribution margin. So this is equal to, now fixed cost has been given as $2,000. So 2000 divided by the unit contribution margin, which is $80. So 0 gets cancelled with 0, and 200 divided by 8 is 25. And this is what we had seen earlier here. At 25 units, the operating income is 0, which is no profit, no loss. So this is the break-even point. Now we can also calculate the break-even point in terms of sales. So break-even point in terms of sales is fixed cost divided by the contribution margin percentage. So 2000 divided by 40%. So this is the 40% that we have used here. So this is equal to 2000 divided by 40 multiplied by 100. This is, I have converted 40% into numbers. So 40% is 40 divided by 100 and 100 I have brought up. So 2000 multiplied by 100 divided by 40. So 0 gets cancelled with this 0. 4 5s are 20. So this becomes 500. So 500 multiplied by 10, this becomes 5,000. So a total sales of $5,000 needs to be done in order to break even, which is the same as this number here. That is, a total revenue of $5,000 is going to happen at a quantity of 25, and that is where we are breaking even.